what I want to do here today is I want to go very in depth on what you need to do with your money, given that the Federal is now flipping the other way. And I want to take you very in depth and show you past cycles. We're going to go extremely in depth. This is a type of comprehensive video that I'm honestly the only one that puts out this level of comprehensive videos on YouTube. I know what everybody else is putting on out there, and this is the highest level. Alrighty guys, let's start diving in here. So past 20 years, what conclusions can we draw from this? Okay, this is looking at the past 20 years of the federal funds rate. One conclusion we can draw here is we're the highest we've been. That's just factually over the past 20 years, right? Over the past 2 decades. 2, we've been high for pretty long now at this point in time. If we look at how long we usually stay at a very elevated place, we're up there now at this point in time. We're pretty much, about as long as we were in the great financial crisis is about how long we're going to be up here now, right? But we're a little higher than we were at the great financial crisis prior to that time, right? And we're looking at likely a multi-year cut cycle. So that's an important thing people got to understand is this is likely going to be a cut cycle that starts in 2024 and it might not end until like 2026. So it's just a little food for thought in regards to that. Okay, so this probably has quite a ways to go. And we really only had 3 hike cycles over that span. We had this one prior to the great financial crisis. We had this one, which was kind of, it started way back in kind of 2015, 16, and then ran through until about 2019. And then we had this recent one, right? And obviously this one was because inflation went completely out of control. This was an inflation problem as well, but it wasn't this severe of an inflation problem. Now, the important thing you got to understand when we look back at these different hike cycles or cut cycles is whenever the Fed is moving by 25 basis points, picture it kind of like a cat, okay? You ever see a cat kind of like, let's say there was like a bunch of boxes over in an area, right? A bunch of tall boxes. A cat might kind of like touch it, like make sure, is it okay, right? Testing the waters, like, okay, can I probably make this jump and these boxes are going to stay up, right? 50 basis point move for the Federal Reserve is kind of like the cat actually jumping. And it's like, this is what I'm doing. This is where we're going. Like, this is clear our direction. We're not testing the waters anymore. This is the direction we go. 75 basis points or more in terms of Fed raising rates or dropping rates, that's panic mode. So picture the cat jumped on the boxes and then it's like, all these boxes aren't stable and it jumps off and it's panicking, right? That's the Fed whenever they make a 75 basis point move, okay? So always keep that little kind of, whatever you want to call it, illustration I just put in your head there. Remember that for the Fed when you're thinking about 25 versus 50 versus 75 or more. So in regards to the latest rate hike cycle, this was pure panic. They started out by testing the waters, right? March 2022, they tested the waters, 25 basis points. Then they're like, okay, let's definitively make sure we're moving in a direction. They make a 50 basis point move, right? Like, this is the way we're going, we're hiking. And then they start panicking. 75, 75, 75, 75. When you make that many 75 basis point moves in a row, back to back to back to back, you're in full-scale panic mode as a Federal Reserve. And it makes sense that they were in panic mode. They did not start raising rates nearly fast enough, right? And they didn't start raising them early enough. They should have been raising rates already in 2021. You were already seeing plenty of signs of inflation was an actual issue in 2021. They should have started raising in 2021, and then they could have kept that going in 2022, and we probably wouldn't have had to face as problematic inflation as we did end up facing in the end, right? Now, if we look at the kind of 2015 to 2018 cycle, this is what you would want to look at if you want to look at it like an orderly, perfect cycle. 25 basis points up, 25, 25, 25, 25, 25. Like, that was a very natural, orderly, perfect cycle. The Fed didn't have to freak out in there. We had a strong economy during that particular time, right? Along with no real inflation problems, right? And you're always going to have inflation in the economy. That's what you should have, right? If you have deflation, that means you're already in massive recession. You should always have inflation in the economy, and we certainly had that from 2015 to 2018, but it wasn't out of control. It was controllable inflation, the sort of inflation the Federal Reserve likes, the sort of inflation the government likes, the sort of inflation that corporations like, right? And we had a strong economy during those particular years. And so it was an orderly, perfect cycle. Then, right, we had the Fed test the waters a little bit, and we actually had an orderly cut cycle. 25 basis points down, 25 basis points down, 25 basis points down. That was all orderly. And then we had a black swan event come, a once in 100-year health event, right? And the Fed had to panic and they cut all the way back down to zero. During that situation, they took down 50 basis points, and then literally not even 2 weeks later, they cut by 100 basis points. That is pure panic, right? Then we had this was the rate cut cycle in the great financial crisis. Now, it's important to understand the Fed was clear right from the go, like we're cutting, we're moving here. But then they started to back off and they started doing, kind of what would be seen as like very Tesla water type cuts. 25 basis points in October, 25 basis points in December. Why are you going to move 50 and then just start moving 25? That seems kind of like babyish, right? And I believe at that time what they were scared of is some commodities were starting to jump back up during that particular time. And I believe that led the Fed to kind of be a little concerned about maybe let's not lower rates too fast because we don't want commodities to go crazy. And commodities ended up still going crazy into 2008, right? Now, the important thing to understand about this could happen. This could happen in this cycle where let's say the Fed starts lowering rates, okay? You could send the commodities market upward in a significant way after the Fed starts actually cutting rates. And if commodities all of a sudden start going through a bull cycle, right? Imagine oil starts going up big, natural gas starts going up big, right? Lumber, coffee, everything, right? Boom, 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 boom. That could freak the Fed out big time because then they say, oh my gosh, like inflation might come back 6-12 months from now because these commodities are all going up so much. And we might stick ourselves in a situation where we're going to have to stop cutting rates, or we might have to start going up back again on interest rates again. This is a huge risk that not a lot of people talk about or think about when they're thinking about a rate cut cycle. They assume like it's all just gravy and it's all just fine. No, if you get commodities running again, you could set yourself up for a complete disaster because then you're stuck in a situation where you could have inflation starting to run wild again while you got a weakening economy. What do you do in that situation? Do you have to sacrifice to inflation and cut? Do you not cut and then let the economy get devastated? That's a big problem. We could run into that problem next year, folks. And I'm just mentally prepping you ahead of time. It's a potential, okay? It is a potential. It is a risk you have to consider. Now, by the time we got to January of 2008, the Fed started to full-on panic, right? They look at this. January 22nd, they cut 75 basis points. 75 basis points is already a panic move, right? And then 8 days later, they cut another 50 basis points. Pure panic, the Fed was at that particular moment. Then they do another panic cut of 75 basis points again, March 2008. These are sorts of things that freak a market out, by the way. You might assume like, oh, the market would love this. 75 basis points, 50 basis points, 75 basis points, cuts. No, that's the type of stuff that freaks the market out like, oh my gosh, what's about to happen in the economy? The market can deal with a Fed that's orderly and they're like going in one direction. They can deal with that. They cannot deal with a Fed in pure panic mode. And that's what we had at that particular time. Then it was pure panic after that, right? October 8th, 2008, they cut 50 basis points. October 29th, they cut another 50 basis points. So in a matter of 3 weeks span, that's 100 basis points of cuts. And then December, they cut the final 100 basis points, right? Which was just the Fed just giving up at that point in time. Like, we lost it. We lost it, right? And keep in mind, when they already are making these panic cuts, they're already basically admitting defeat. They're already admitting they lost, right? No different than 2022, which we go back. Where's our 2022 cut cycle here? Right here, this time period, right? And we had Jackson Hole somewhere around here. This was a Fed already signaling we lost it. We lost. Like we're in full scale panic mode. We lost to inflation. We're just trying to do whatever it takes now at this point in time. And that was the Fed certainly in the 2008 great financial crisis, just on the other side of cutting. Like we lost, we're just in panic mode, cut it down to zero. Okay. So now, important. It's very important everybody understands this. The Fed usually moves too slow at first. So it doesn't matter if it's a hike cycle, a cut cycle, they're usually going to move too slow compared to what they should be moving. So, think about the hike cycle that we went through in 2022. 1, the Fed should have started sooner. 2, the Fed should have went more aggressive from the go. It should have probably done 50 basis points, 50, 50, 50, 50, right? Start that at the end of 2021 rather than March of 2022. They were just way late to the game and they weren't raising fast enough, right? And that led to those panic raises of 75, 75, 75, right? So this is something important to remember. So likely, I would say there's a pretty high probability here that when the Fed starts cutting rates, they're probably not going to do so aggressive enough. They probably should have already started cutting rates, and they're probably going to move too slow. If you're going to put the odds on it, you're usually going to have to say they're probably going to mess it up, right? It's just history. It's just history. Hey there, it's Jeremy. I hope you really enjoyed that clip here today. What I'm showing you right now is 1000xstocks.com. This is a specific software that has been designed to save you time. It's a one-stop shop for long-term investors to know how the company is doing, listen to what management has planned for the future, and compare companies next to each other. Which big tech is the most undervalued? Is that small cap company you heard of actually worth investing in? Or are there red flags? Get the front row to the conference call, be able to access the management, which information is right to make an educated decision. Get all that information through 1000xstocks.com. You can access that through the description area. You can apply for access to 1000xstocks.com, or you can go to 1000xstocks.com. So my opinion, the real danger is if you're betting on only one outcome here. If you're like convinced in your mind, like it's only going to be a crash or it's only going to be risk on, here we go, baby. I think that's the big mistake, because there's too many factors at play here to be betting on only one outcome. If we had, let's say, folks that were running for office that weren't going to be big spenders, along with no big infrastructure bills like all these that are going through right now, and we had a housing market decelerating rather than accelerating, I would say I would bet on a crash, actually. I'd be betting heavily on a crash if we didn't have all these factors at play here. So, I mean, I can't say for sure like, oh, we're crashed, because you just had too many factors at play here. So what do? Here's what I'm doing, okay? I'm going to remain heavy long stocks in real estate. I'm a huge believer in time in the market beats time in the market. Huge believer of that. I've seen it too many times just in my investing history where you could get very scared, you get very concerned, oh, the market's going to crash, this is going to happen, we're destined because this lines up with this, and this happened in the past, so boom, crash. And then it doesn't happen, right? And I've seen other times where people aren't expecting a crash at all, and then that happens. And also you got to keep in mind, there's a great saying in the stock market, it's one of the most true sayings, okay? Bull markets are built on pessimism, and then they grow on, I forget the perfect term for it, essentially. The bull markets grow on kind of like people still being concerned, like skittish, a little skeptical of this bull market, right? And then they die on euphoria. Well, we just don't feel like this is a euphoric market right now, right? It would be much easier if I saw huge amounts of call buying right now. If I saw everybody out there saying, oh, we're going to the moon, baby, the economy is good, soft landing guaranteed. If I saw all that, I'd be able to say much easier, like, oh, this is the end. Because bull markets die on optimism. Look at 2021, it died on optimism, right? Look at 2007, you had a lot of optimism there. Look at the tech bubble. We don't really have that. We have a market at all-time highs, but the market sets all-time highs almost every year. Like, it's a very common phenomenon unless you went through a crash, right? So you can't really just say that. There's a certain feeling. There's certain data points, and it's hard to really make that statement about that. I'm going to keep buying growth, value, dividend stocks weekly. I've been leaning very heavy to value and dividend stocks recently rather than growth stocks, and I'm going to continue to be heavy in profit companies that make a lot of money, because I want to be in the sorts of companies that they do well regardless. Inflation, deflation, bad economy, good economy, okay economy. I want to be heavy in those sorts of companies that they perform, they put up their numbers regardless, right? And if you look at where my big money's focused, those companies put up their numbers regardless. Like, it doesn't matter what's going on. Oh, these companies are all facing weakness. These companies are doing great, right? So that's what I'm going to do. I'm going to also hold about, I would say probably between $500,000 and $1.5 million of cash in 2025. And I'm going to still be able to earn 4 to 5% range in 2025. Because you got to understand, when the Fed does start lowering, and it's going to take them a while to get rates down. It's going to take them a while. So I'm going to still likely be able to earn either through high yield CDs, high yield savings accounts, or treasuries. I'll still likely be able to yield probably 4 to 5%. Maybe toward the very end of 2025, like the fourth quarter, I might I might only be able to get like 3% or something like that. But for now, like this is the best it's ever been. Like for my generation, the millennial generation, we never got to see rates of 4 to 5% at the bank, right? And so right now, high yield, you get that sort of numbers. Treasuries, you get those sorts of numbers right now. So I'm going to continue to hold a good amount of cash and have that cash earn interest. I love to see it. I mean, it's beautiful when you can make, $1,000 plus a month, if not multi-$1,000, just by holding money in high yield savings or in a CD account. It's a lot of fun. It's a lot of dang fun, right? Now, additionally, I'm going to hedge going into 2025. I'm going to hedge probably somewhere between $50,000 and $75,000. Remember, when I hedge, I'm going to go smaller because when I'm hedging, it doesn't take a lot of money to make a huge difference. Like if we do get into some sort of situation where, let's say in 2025, the S&P 500 sells off 25%, right? Gosh, the amount of money my hedges would print. Like if I put $50,000 into some hedges and I properly hedge, right? The 50,000 could grow into $250,000 to 300,000, right? If you talked about a big downward move in the market. So that's kind of my covering my backside, just in case. Just in case. Maybe it is the next GFC. And if it is, I'll make a lot of money on that. And guess what? Then the S&P 500 goes down 25% plus, right? All of a sudden, I made a profit of, let's say, $250,000. Then I got an extra $250,000 I can now put in the market as stocks at extremely low prices. Now, let's say everything's fine. Everything goes up, 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 up. Sweet. That's fine with me as well because the $50,000 I risked, let's say in hedges, ends up being a very small amount compared to how much I gain in my longs because my long portfolios might be up $500,000 on the year, $1 million, $1.5 million, depending upon how well those positions do, right? So 50,000 out of that's nothing, so that's kind of the way I think about that as well. Hey there, it's Jeremy. I hope you really enjoyed that clip here today. What I'm showing you right now is 1000xstocks.com. This is a specific software that has been designed to save you time. It's a one-stop shop for long-term investors to know how the company is doing, listen to what management has planned for the future, and compare companies next to each other. Which big tech is the most undervalued? Is that small cap company you heard of actually worth investing in? Or are there red flags? Get the front row to the conference call, be able to access the management, which information is right to make an educated decision. Get all that information through 1000xstocks.com. You can access that through the description area. You can apply for access to 1000xstocks.com, or you can go to 1000xstocks.com. First one up here, the Fed is taking on risks they don't have to, says the professor, Jeremy Siegel. The moral of that story is the Fed's taking too much risk by not lowering rates. We'll react to what Jeremy Siegel says here. Now, if the Fed starts cutting, okay, we could end up in a problem here, okay? Let me describe a problem to you guys. It's always my job to get you guys mentally prepared for things that haven't transpired but could, right? Before everybody starts talking about it, because by the time everybody starts talking about it, it's too late. So, we do have a potential problem here. When the Federal Reserve starts cutting rates, we could see a phenomenon where commodities start a major upcycle. It's not a guarantee, but it's a serious potential. And specifically things like oil. Now, if the Fed starts cutting, oil starts going up substantially, it's going to lead to inflation fears, right? And the further oil was to go up, or commodities in general, the more it would lead to more and more inflation fears for really, like, let's call it 2025, 2026, which would then potentially put the Fed in a situation where they couldn't lower as quickly, right? It also then leads into a problem of inflation and hitting the consumer again. So it is a risk factor. It's a risk factor we have to account for. We have to take that serious, and it is a potential. And you actually did see that prior to the Great Financial Crisis. The Fed started lowering rates in, I think it was September 2007, if I recall, right? It was definitely later in 2007. I think it was around September 2007, which is kind of scary. And then what happened after that, commodities went through a very big kind of bull cycle there, and that helped push the consumer even more into recession. The Fed didn't lower rates probably nearly as fast as they could have, right? Because commodities were starting to run huge, oil was starting to run huge, and then what ended up happening was a great financial crisis, right? So that's something we got to be aware of. It's a serious risk. Let's react to some videos.
To join us right now to talk about the data, the markets.
The Professor Jeremy Siegel.
Fed commentary, maybe what we're going to hear out of Jackson Hole Jeremy Siegel, Professor Emeritus of Finance at the University of Pennsylvania's Wharton School of Business, also Chief Economist at Wisdom Tree. Good morning to you, sir.
Good morning.
So
Andrew.
what do you think of the jobless claims number? What do you think of this sort of larger, revision going back a year? Does it matter?
Let me try to explain where I have trouble with Fed policy. The Fed has stated that its long-term Fed funds rate is 2.8% when risks are balanced. Now, taking a look ahead 6 months, if I were to ask you, what's more likely, a flare-up of inflation or a weakening job market? Now, we got decent numbers certainly today, but between those two, I say it's balanced, maybe even more towards a weakening job market.
Fair.
Well, then why are we at the most restrictive monetary policy in over half a century if we have almost a risk-balanced look going forward? Now, a lot of people came back to me when I was, really agitated a couple of weeks ago. They said,
and you wanted 50 basis points, and then you switched gears.
I wanted 50 basis. They said, it's not 2.8%. They put that down, but it's really much higher. The economy's doing well. It's 5.3 right now. Economy's doing pretty well. Maybe that neutral rate is 4.8%. So they only need really a couple of cuts to get to that particular level. Well, if the neutral rate for Fed funds is 4.8 instead of 5.3, then why is the 10-year bond at 3.8? If you go through history, normally the 10-year bond is about 100 or more basis points above the neutral Fed funds rate.
That's fair.
Which would put it at 5.8. Wow. Not at 3.8.
Right.
Something is sort of out of kilter here.
So what's the answer then? Meaning, what would you do?
I think the Fed is moving way too slow. I think they're taking on risks they don't have to take. If they would move it down faster, and I know that, Steve said it's 25, 50, 25. I mean, if they go 50, 50, if they get back down towards that 3 grade, I actually think it's 3.5, a little bit higher than what they said. But the faster they get down, the lower the probability that they're going to have a recession and a significant slowdown in the economy.
Yeah. So we definitely see eye to eye, 50-50. That's what I've been saying. Do a 50 here in September, do another 50 in either November, December, and then call it a year. Take us down 100 basis points, put us to 4.25 to 4.5 Fed funds rate. Cool. And then let's see what happens next year. Do we see another spike up in commodities once the Fed starts cutting? Keep an eye on that, right? Let's see. And then we can play it how it goes. Okay, inflation's still chilling. Let's say jobs market, we're not quite liking the numbers. Okay, then we can lower another 25, 50 basis points toward the beginning of 2025 and kind of take things from there, right? The one thing I'm fearful of is they go too slow here at the beginning, and then they get in emergency cuts because let's say the economy weakens a lot more or something like that throughout 2025. The jobs market weakens a lot, and then all of a sudden they're in some sort of emergency. And next thing you know, they're doing 75 basis point cuts, right? It's not going to look good for the market. It's not going to look good for the economy. It's not going to look good for anything. It's going to freak people out. No different than what happened in 2022. When all of a sudden the Fed started having to do those 75 basis point raises, everybody flipped out, right? I mean, that's the type of stuff that freaks people out. You can get away with 25s and 50s, and people won't go that crazy. They're like, okay, the Fed's moving considerably in a direction, but it's not out of control. When you start going 75 basis points or more per cut or per raise, people get freaked out fast. And that's the stuff the market doesn't like. That's the stuff CEOs don't like. It's hard to plan when you're getting 75 basis point moves at a particular time or more. So do 250s here at the end of this year, and then let's see where the cards lay after that. I mean, even at 250s, you're at 4.25 to 4.5, right? And CPI's in the high 2s right now. You're good. You're good. If we had CPI in the 4s right now, then I'd be okay. We're a little concerned because then we're basically cutting to where we're at CPI. We're good, man.
That's basically, I would like them to explain one with risk nearly balanced. Why are they twice as high as they should be?
Okay, let me ask you a different question then. Given what you know, given what you want them to do and what you think that they may do, how are you thinking about buying or not equities in this market?
I think equities are, they're basically you're at 21 times forward earnings. It's S&P is within 1% of an all-time high. 21, I've often said 20 is equilibrium, so it's a little high. If you take out, the
21, can you do something for me?
Egg 7, you're at 17, 18. They look more attractive. I don't see the small and value stocks moving until the Fed moves. And maybe
No, sir. We're already seeing value stocks move. We're already seeing some of these small cap stocks move, right? We're already starting to see that over the past, I would say, 6 to 12 months in regards to some of these stocks. Some of these stocks are later in the game. They just started making their move really in the past month. Others have been making a move for 3, 6, 12 months now at this point in time. So I definitely disagree with him. Even the Russell, if we just want to look at the Russell 2000 as a whole, right? Look at the Russell's move since around October, November of last year. It's a substantial move to upside. Now, the Russell still has to play a lot of catch up to the S&P 500 and to the NASDAQ, which could be very, very exciting. I can tell you if you own a few small cap stocks. But the move has already started, in my opinion.
Convincingly, I think that Chair Powell is definitely going to open up.
It's not even my opinion. It's just factual, actually.
Tomorrow, in his speech, he will not specify how much it'll be. They still have 4 weeks of data coming. I certainly hope it's larger rather than smaller to get back to where I think that neutral.
That's what she said.
It is.
And then, Professor, we keep asking the same question, in part because the DNC convention just happened or is happening right now, and they are. Republicans had their convention a couple of weeks ago. Do you think that the market is saying anything about which way the White House is going to go in November?
Well, I think that if the Dems get all three branches of the government, presidency, House, and Senate, then it's more likely that Senator Harris's tax plan, and we all know that all taxes need to be renegotiated on December 31st of 2025. Many of them are likely to be implemented. If the Republicans can hold either the House or more likely the Senate, and it looks like that could be very, very close.
Yeah, I mean, to assume the Dems are going to take everything? No, that's not happening in my opinion.
Then basically, Harris's plans, I wouldn't say are DOA, but they're much less likely. The government still needs to renegotiate everything at the end of next year. The composition of the Congress, as well as the presidency, is really important. I don't think the market is yet focused on a 28% potential corporate tax.
Yeah, I mean, my opinion is if Harris wins, I do believe that she's not going to be able to get very much done the first couple of years. Which, if you don't like her policies, by the way, you're going to be very happy with because you don't want her to get stuff done, right? And so that I think is going to be the more realistic situation. And at this point in time, do I think Harris is going to win? Yeah, I think if I had to put odds on it, I'd put like 52% probability she wins versus maybe 48, for Trump now at this point in time. Whereas if we went back to a month ago, was Trump in a landslide over Biden, but there's a huge, one side lost a lot of momentum. The other side went like straight up to the moon in regards to kind of their momentum there. So, yeah, but at the end of the day, if she wins, she's not going to get crap done that first couple of years. She's going to get blocked left and right because I believe Republicans are going to do pretty well in other races, and so therefore I think it's going to make it very difficult for her to get anything done in those first at least 2 years of her presidency. Which, once again, if you don't like her policies, that's something you're gonna definitely be in favor of, right? Because if you don't like somebody's policies, you don't want them to have an easy path to be able to get stuff done, right? You want it to be challenging.